Welcome to our session in managerial finance, also called financial management, also called corporate finance. So in our introductory chapter, we will basically look at the roles that financial managers have and what the course is all about. So financial management, which is also called managerial finance or corporate finance, like I mentioned, can be defined in a number of ways. So number one, it is financial management is the acquisition, management, financing of resources for firms by means of money with due regard to prices in the economic markets. So when you're dealing with financial management, we are dealing with what? Money and management. So it is from this definition that we can define the roles that a financial manager has. So a financial manager has four key decisions that he needs to make. They are what we call financing decisions, looking at how a business will be financed. Will it be by debt or by equity? Financial manager also has investment decisions. So by acquisition of assets, we must understand how to make investment decisions. And these investment decisions have to include capital budgeting process to making decisions on which project is viable, which project pays more. So this decision-making process also includes what we call dividend decisions, where you determine how much dividends will be declared to your the shareholders. So financial management is very important, or corporate finance is very important, in that it will help you understand a number of key issues. So these businesses that will be run take up a number of forms. So every country consists of two sectors. We have the private and we have the public sector. Private sector and the public sector. So public sector is run by government, whereas the private sector is in private hands. So regardless, in the private sector, we have a sole proprietorship. These are businesses owned by one person. This person will enjoy all the profits, and the person makes all the decisions. Examples could be a shop, a plumber, a carpenter. Typically, these will raise all personal resources for capital. He is responsible for all the decisions, and it is a very easy setup to make. So these work independently. These are entrepreneurs. The major drawback or disadvantage with this kind of business is that they have unlimited liability, which means the liabilities of the business are the same as the entrepreneur's liability. So meaning creditors can claim against the entrepreneur's personal assets. And we evolved to what are called partnerships. These are two or more people who come together in exception of accounting firms or law firms that are limited to 20. So partnerships are governed by a law or articles of partnership that we call a partnership deed. These can either be oral or verbal. The partnerships are into two categories. They are what we call general partners and limited partners. The limited partners are limited to how much they invest in that particular business. Then we go to companies. Cap 388 of the laws of Zambia entitles organizations to wear a veil of protection. And this veil of protection gives them legal entity or identity where they can own um, a personality. They can sue and be sued. So the business becomes a separate legal entity. And advantages are that number one, you can sell shares to raise funding, which is a lot easier than using pocket money. Number two, you have limited liability, meaning in the case of creditors, you cannot touch your personal property. Number three, the original owners are able to keep control of the business by restricting share distribution. Disadvantages is that owners need to deal with a lot of legal formalities. It's expensive. You have to publish articles of association, memorandum of association, certificates of incorporation, so it's complex. Then we have what are called public companies. The public companies are similar to the private companies in that you are now able to go public and sell your shares at the stock exchange. You are entitled to general meetings day every year where shareholders are invited to elect a board of directors. And the shareholders are the ones who own the business. Directors are the ones who control the business. The advantages of these companies are that they have limited liability, there's assured continuity. Unlike the partnership and proprietorship, the death of an individual automatically shuts the organization. Here, the death does not limit, so there's continuity and potential to rise, raise limitless capital. So there are no restrictions of transfer of shares in this kind, and there is high status to attract investors depending on how the company is being managed. The disadvantage is that there are very many legal formalities to form. It's expensive. Selling of shares could be expensive, and commission paid to brokerage. It's also difficult to control when it becomes too big. So, practice questions here. Um, Financing. What are the key decisions that financial management may include? These are financing decisions, investment decisions, and what? Dividend decisions. So, what is involved in investment decisions? Here we're looking at what? The capital budgeting, where you need to decide on which investment is more viable. Includes calculating our NPV, IRR, and NPV. That's what we're going to look at. Then, lastly, but not the least, we must
Wait, guys, this.
understand the legal form of a business that is most common. Which is the most common legal form of business that is dominant. It's a limited company. And what are the characteristics of a um, limited company? Anyone? I'm just from talking about the introductory part here. What are the characteristics of a company? I've talked about two companies. Which companies have we talked about?
About private company and public company.
A private and a public company. And what are the features of a private company as well as the features of a public company? So the ladies, let's talk about the public company. The gents talk about the private company. And also an exam question would come, Mr. Banda wants to um, convert his private company into public. Give reasons why. So these are questions that examiners would want you to know. So let's start with the features of the private. Quickly. Haven't they started doing the actual, it's introductory. Okay, ladies, features of public.
They make all the decisions for the private company.
Mm-hmm.
They also organize resources to finance the company.
Mm-hmm. So features of a private company, I said in terms of ownership, the shares are held by what? The shares are held by a small group. It can be a family or friends. And these shares can't be freely traded on the stock market. These shares are internal. So the minimum number of members in a private company is two. The maximum is 50. It varies from country to country. So raising of shares really relies on personal funds and the retained earnings. So for limited companies, private limited companies, um, the financial information, okay, it needs to be made public. The decisions are faster. because there are fewer people involved. But for a public company, ownership is owned by the public and is traded on the stock exchange. And the shares here are transferable without restriction. And the minimum number is 7, and there's no maximum number. You can have thousands and thousands. And so raising capital can be by issuing shares or bonds to the public and making it easier to raise large amounts. So disclosure requirements in the public company is that you need to have a detailed statement that must comply with the restrictions. Decision making here is slower because you have a number of people there. So the question is, why would you encourage your grandfather to go from private to public? Number one is he can raise more money, more funds, okay, if it's limited, and also liquidity for owners. The original owners can sell part of their shares because you can easily sell to anyone. Then brand visibility. So if you are listed on the stock exchange, people can easily buy your shares. Then growth opportunities. Access to funds will allow you to enter into markets or products. Then attracting talents, you can have an ability to offer stock options where employees can be given those stocks to become what shareholders. All right. So you need to really understand that in that context. Now, there's what we call urgency problem. The urgency problem arises. So what is an urgency problem? You've heard of urgency problem? So in being a limited company, you will appoint managers that will run the company on your behalf. And those are the board of directors. So they will act as agents on behalf of the company because they are not the owners of the business. So in so being the case, there is sometimes a problem where those agents who are the managers are expected to act in the best interest of the company. However, they'll enrich themselves through bonuses and incentives to secure their jobs rather than to retain a dividend to the owners. And thereby we bring in the concept of the urgency problem. So the urgency problem results in having a mismatch between the goals of the managers and the goals of the shareholders. So this now brings in an issue of the urgency problem. So assuming that we restrict these to profit-making organizations, I'll try to be as practical as possible so that you understand this very well. So if we're going to consider,
Colin, just overemphasize a little bit on the urgency again. Sorry.
so I repeat, on the urgency problem, I must mention in simple terms that an agent or agency is simply a relationship where one who's an agent is authorized to act on behalf of another person who's a principal. So when the board chooses managers to run the business affairs on behalf of the company, because the company is owned by shareholders, there is an agency relationship. The managers are agents. The shareholders are the owners, the principal. So the agents who are the managers are qualified personnel who are expected to act in the best interest of the company by ensuring that when they make profits, the dividends that are collected are paid to the respective owners. Now, in running a business, there are a lot of costs that we have. There are a lot of loans that we get. So, in terms of loans like bonds, a manager would want to choose between borrowing from a bank or just plowing back because we've made a profit. Managers would now want to say, instead of giving the owners this money, let us plow it back because when we borrow money, we're going to pay high interest. And sometimes managers will have a tendency of giving themselves bonuses, securing their jobs. So this urgency issue is what the shareholders want to really ex explain have a problem explained to say, how then are we going to strike a balance? How do we know that these ones are acting in the best interest of us, the owners, on their own best interests? Okay? So, in short, agency problem is a situation that arises when there's a conflict of interest between the principals, who are the shareholders, and the agents, who are the managers, to run the company. So the principal wants the agent to act in their best interest by maximizing their wealth, whereas the agent wants to pursue their own interests, like getting higher salary, perks, and job security. So what causes this agency problem? The separation of ownership and control. So in large organizations, the owners are usually supposed to be different from the managers. This is what makes monitoring difficult, because by law, if you are the business owner, according to entity concept, it says you two must be different people. You can't be the same. So they'd rather have an independent person. Now, this independent person, how sure are we that this independent person will act in their own interest? The other problem that causes agency problem is information asymmetry. Managers usually know about the company's operation better than shareholders, so they can exploit them. So, these ones are laymen. Yet also having different goals. Managers want profits, whereas shareholders want their profits to be dividends, whereas managers want to focus on personal rewards. So the manager would be using company funds for luxury cars, offices, avoiding the risky but profitable projects. So this is the agency problem in short, in a simplified manner. I hope it's clear. All right.
It's clear, sir. Thank you.
All right. So we're still in the introductory. I'm trying to simplify all this jargon of notes. I've sent you the the notes that you can read on your own, but exactly what I've said is what I've just summarized in here. Principle, how to manage the urgency problem. Okay. So another way to attempting to minimize urgency problems is having auditors to audit the company accounts. These ones will see whether these were done in the best interests of the business. So exercise questions: what is the goal of a firm? To maximize wealth. Discuss measures, how one measures achievement of this goal, and what are the three basic reasons profit maximization is inconsistent with wealth maximization. All right. Then we go to the financial systems and financial markets. So we have what we call a financial system. A financial system is simply one that plays a very important role in the economy to stimulate economic growth. It is achieved by having a financial infrastructure which is able to allocate funds to those that have use. So the system allows you and me as small savers to put monies in a bank, for instance, and the bank which is reputable will able to find people who borrow that at an interest. So all this happens in a financial system. So financial system has three main components. We have what we call the financial markets, the financial intermediaries, and also the regulators. Are we together so far? Are we together so far? Any questions? Okay, if there are no questions, I'll go to explaining this. So we'll start with the financial markets. What are these financial markets? The financial markets basically are the platforms or arrangement where financial instruments like the bonds, the shares, the derivatives are bought and sold. So this, are you seeing my screen? Are you able to see my screen? So the financial markets are what? Platforms where instruments are bought or sold. Which instruments are we looking at? The instruments like the bonds, the shares, the derivatives. So in these financial markets, we have what we call the capital market and the money market. Capital market includes long-term securities like bonds, like stocks, like debentures. And it also has what we call the money market. Money market looks at short-term instruments within a year, like treasury bills, commercial papers. So capital markets are to do with more than 1 year. Money markets are to do with less than a year. We also have other markets like the foreign exchange market, where currencies are traded, and the derivative markets where we look at the options. But key, I want us to look at the two markets, the capital and the money market. So the long-term funds are traded in the capital market. Derivatives, that's where we have futures, swaps for managing. So this is about the financial markets. When we have financial intermediaries, these are players. These are there to stand in between the savers and the borrowers. They are usually there to help um, ensure the transfer is efficient instead of savers lending money directly. You want to use intermediaries that are renowned. These intermediaries may include commercial banks. They accept deposits and give loans. Insurance companies, they're there to pull your risk and they protect you. Okay. So we have banks, we have insurance companies, we have uh, pension funds are there to collect retirement savings, basically. And we also have investment funds or trusts that are there, and microfinancial institutions. So basically, the financial intermediaries are there to do what? To reduce the transaction costs and to provide liquidity and to spread the risk. Then we also have regulators. These regulators are there to supervise the operations of the financial market and intermediaries. So regulators, can somebody tell me any regulators you know? We have what? Bank of Zambia. It's a regulator. It regulates money, the monetary policy, the Securities Exchange Commission, SEC, which is there to oversee what the capital market and the stock exchange, the pensions, PIA, pensions and insurance authority, it regulates the pensions, and Zambia Revenue Authority, it regulates tax. So these regulators there to protect investors and consumers and to maintain what? Financial stability and to prevent insider trading. All right. So basically, this is what is happening under this section, unless there are any questions. Okay. All right. So you see now the financial markets work and how monies flow. Financial markets are there to ensure that funds will go uh, to the people who are borrowing from the savers to people who are borrowing. And these people who are borrowing can take this money, financial institution, it grows and it goes round and round. So this is how it moves. All right. Any questions at this point? We're clear. All right. So I've talked about the types of markets, money markets, we have treasury bills, okay, repurchase agreements, all these are in the money market, the commercial papers, the certificates of deposits, the bankers acceptances, all these are in the money markets there. And we also have the secondary market where we do the long-term um, instruments. Financial institutions, I've talked about them that are found in there to help facilitate um, transactions. And I've also talked about the stock market, which is regulated by the Securities Exchange Commission. And also we look at the bond markets. So this is on the introductory part. Unit 5 is talking about time value of money. So time is money. And for this reason, you need to value it. So we're going to look at the concepts of time value of money, the patterns, annuities, differences between annuity due, the present value of annuities, the future value of an annuities, what an annuity due is. All right. So time value of money. The time value of money is very important component because a dollar today is worth more than a dollar tomorrow. So in this principle, we want to understand the concept of investment analysis in managerial finance. So why does time value of money, why is it important? Because it's important to evaluate investment projects. It's also important to decide on the different financing options, also determine the present value of the cash flows, and also making decisions on bonds and loans that we've talked about. So the formulas we're going to look at are simple interest. Simple interest is simply given by what? PTR, where P is a principal, T is a time, and rate is a percentage. Then we also have what we call future value. Future value is given by the present value, 1 plus R to the power time.
You
This
can't
is,
see the formula, sir.
are you able to see my writing in the corner here?
Yes, we can, up to why time value of money matters in managerial finance.
Uh, are the rest able to see what I'm writing? I'm writing something in the corner.
No. Can you go ahead and write?
Right now, I'm actually writing. Are the others able to see what I'm writing? Sometimes your network is not very okay. Please confirm if you're seeing what I'm writing in red. All of you are not seeing what I'm writing. It's Enoch, are you seeing what I'm writing? Hello? This class is very
He has said
quiet.
yes in the chat.
Pardon?
He has said yes in the chat.
Okay. So, are you seeing? You're not still seeing what I'm writing in this corner here.
I've seen the ballpoint in green.
Oh, the red points. I don't know. The red, I'm writing in red.
Writing in red.
It's your network. Maybe exit and join so you see clearly. So simple interest is
I
PTR.
can see now. I can see now.
Okay, the future value is simply the present value 1 plus R to the power T. So if it's compounded more than once, our interest rate is divided by the number of compoundings M, and our time is multiplied by the number of compoundings M. So what does it mean to be compound? To compound is to earn or charge interest. So if interest is earned or charged once, that is annually. So the number of times our M will be is 1. So M is 1. If it's semi-annually, it means twice. So our M is 2. If it's quarterly, who wants to try? If it's monthly, how many times is it? If it's weekly, how many times is it? If it's daily, how many times is it? So quarterly, how many times a year? 4 times, right?
And 4.
Monthly, 12 times.
Well,
Weekly, 52. Daily, 365. So you need to take note of these ones here. So find the simple interest if our principal, suppose the principal now is 1,000 kwacha, and we are told that you are supposed to keep money for a period of 3 years at 10% interest. What is our simple interest? So simple interest is what? PTR. So what is our principal? 1,000.
1,000.
And what is our time? 3 years. And what is our interest rate? 8% or 0.10. So what do we get as our simple interest? 300 kwacha. But B, if they ask you what is the future value, if compounded annually, future value for compounding annually is what? Present value, 1 plus r at the power time. So what was our present value? 1,000. What is our 1 plus r? It's 1.10. The power 3. What are we going to get? That 3, 10. So this is the future value that you're going to have. Meaning here you'd have made a compound interest of 310. Here you made a simple interest of 300 kwacha, meaning the future value you're going to have is 1,300. So compound interest gives you more interest than simple interest. So can somebody try, suppose your interest was 8% and our present value was 12,000 compounded annually for 5 years time. How do we calculate the future value? The same formula. Future value is equal to what? Present value, 1 plus r to the power time. What is our present value?
12,000.
Okay. And what is our interest rate?
8.
So what are we going to put in the brackets? 1.0 what?
1.08
Go to the power what?
to the power 5.
Power 5, correct. Suppose it was compounded semi-annually. What would be the difference? Semi-annually?
Divide the time by 2.
Good. So 12,000. We divide the rate by 2. So 1.0 what? 1 plus 8% over 2. And the time we multiply by what? By 2. Interest rate you divide by 2. The time you multiply by 2. Okay, so we'll end here.